Dear investor, in this edition, let us discuss the following. 1. Gold price increase. 2. Flows, reducing FPI selling pressure and IPOs. 3. Jan to March 15th is a weak period in the market in a year. You would test if sentiment improves, it can reduce the impact. And of course, valuation and conclusion. Now, gold price increase. Over the last 2 years, gold prices have been up relentlessly. Now, Indians have had a long association with gold. According to recent estimates, Indian households now own close to 30,000 tons of gold, whose value is close to $4 trillion, very, very close to the current GDP size. As a percentage of equity holding, the value of gold held is currently near historical highs. A similar peak was seen during the COVID-19 pandemic in 2020. In this period, while equity markets had fallen sharply, gold had continued to rise. The impact on wealth effect, which is what we are focusing on, in a period of high economic uncertainty is likely much lower versus the present, where there is no such comparable economic uncertainty. Now, better wealth effect should result in better consumption outlook. Gold is a very well owned asset class in India. Its ownership is wider than equity or real estate, and hence we think the wealth effect of a rise in value of gold may be felt. However, most Indians do not recycle gold. Yes, the gold loans have grown sharply, but that's only 1.7% of the value of gold. Now, while we do not expect gold holdings to be paid down to fund current consumption, yet the value uptick could potentially improve consumer confidence. Our portfolio includes exposure to segments such as jewelers, jewelry manufacturers, and lenders against gold to benefit from the above factors. The second point, FPI selling pressure appears to have reduced. Net domestic flows have also reduced but are maintained positive. Now, supply of paper may also be peaking out. FPIs have soared strongly in July, August, September. First 3 consecutive months of selling over past 3 years. However, on lower bond yields there have dipped below 4%. A relatively stable currency at around 88 or lower, and much improved relative valuations versus China and the US. We had expected FPI selling to reduce. We have seen this in October. This may continue. Now, gross domestic flows have increased in September, but net have reduced versus the previous month. October is a month of big festivals and investor attention may remain diverted. And we again expect to see similar or lower net inflows in October versus September. So that should be expected unless sentiment improves due to events such as a trade deal or general market buoyancy. Now, month of October saw several large IPOs. Now that these large IPOs are behind, the overall money raised from primary markets may have reached a near-term peak. At the same time, IPOs also often get new investors to the market. If a large IPO results in investor gains, it can have a positive rub-off on investing sentiment. This has happened. We would track new investor addition to the equity culture and flows into mutual funds over the next period. October, though, may see a lower net inflow than in MFs on festivities. Given lower FPI sales, maintained domestic flows, and supply of paper peaking out, the next period could be better for the market as more flows are directed towards the secondary markets. Now, that said, Jan to March 15 has been a period, has been a weak period for the market in 11 out of the past 16 years. Now, this happens as investors await policy moves in the budget and on end of year considerations. Last year was a particularly bad period as this period also coincided with INR weakness, which further prompted FPI selling. Now, this year, this phenomenon can be mitigated if positive sentiment coincides, which is something we watch for. Now, positive sentiment may rise from the following sources. Drop in US interest rate. This has 2 effects. One, weakening of the USD versus other currencies, which increases the propensity of money flowing out of the US. This would also mean a more stable INR. Now, more stable INR helps increase hedge fund activity. Lower interest rates induce yield seekers to hunt for risk-free or less risky yields around the globe. Indian stock markets offer arbitrage, which is less risky. Now, US Fed has indicated a possible rate cut in the next meeting. An uptick in FPI interest, as explained above, may help address the depth of weakness that one sees in Jan to March 15th period. Now, drop in Indian interest rates is the next sentiment booster. We have seen inflation is down in India. With the cut in GST, the outlook on inflation is further improved. This opens up the possibility of a RBI rate cut soon, and the same has been indicated by RBI itself. We anticipate up to 2 rate cuts till the end of this fiscal. If this happens, the repo rate could be at 5%, a low X of a COVID period. This may spur retail interest back into the stock market. Now, this period would also coincide with third quarter numbers. Now, while quarter 2 has been impacted by higher than usual monsoons and deferment of demand on account of GST rate cuts, we expect the quarter 3 to be strong given the strength seen in the festival season already. Better numbers from corporate India could improve sentiment. And of course, a US-India trade deal. Now, this is expected to be concluded one way or the other before Christmas holidays. Now, given the size of our markets and growth, we think we may have some leverage, and expectation is that our outcome would be sub 15% with only a few areas opened up for the US. Or maybe we won't have a deal, that's also possible. If we have a deal, it could support Make in India by offering better access to the world's largest market, the US, for our businesses versus other competing economies. Now, overall, to conclude, at this juncture, there is a lot in the price. Markets have been flat for a year while earnings have improved. At the same time, global markets have been very buoyant, and this has addressed the valuation concern, also the relative valuation concern. With improved sentiment and a possible reduction in interest rates, the upcoming period could be relatively favorable for Indian markets. We think it continues to be time for alpha for the markets. While quarter 2 result season is continuing, companies in newer space such as solar, renewables, cables, smaller IT companies in BFC, etc., have delivered stronger numbers. Banks and IT, large part of the index, have also surprised positively. Overall, good numbers may help sentiment towards the market, but better earnings growth delivery by newer businesses could be the source of alpha. Thank you. Happy investing. May the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.